If there is one company everybody is excited to do more about, is India's largest hotel company, Indian Hotel. And why not? The performance has been absolutely spectacular for many quarters on the trot now. The company for the financial year gone by has reported a solid 4-digit profit. Growth is evident and new properties are getting added at a rapid pace. We've been debating with Puneet Chatwal that is this entire boom scenario really the real deal? And he's argued and he has again and again communicated that the sector and the company which he represents is going through an extraordinary time of reinventing. It is enjoying serious tailwinds in the country, and courtesy that performance which we've seen in the past is clearly here to stay. So Mr. Chatwal, first, thank you for joining us, and once again congratulations on great set of numbers. Whichever way I look at it, you've ticked all the boxes.
Thank you, Nikunj. Always a pleasure to talk to you after the results and before the results.
Mr. Chatwal, while markets always try to look at two basic metrics, which is occupancy rate and what is happening to the ARR. But that is perhaps the sideshow. For me, the real number is that consolidated revenue for the year gone by have grown in mid-teens. It's solid, it is stable, but do you think these growth numbers will sustain?
Absolutely, and I think that's the guidance we have given on a double-digit top-line growth. And I'll give some factors what makes us believe in that. Number one, the most important, demand continues to outpace supply, as very limited supply got added during the COVID time, and it takes time to build hotels. So I think the demand base is very strong, with foreign tourist arrivals yet to go to the pre-COVID phase. That's number one, a very important point. Number two, we have become a very high growth company. So our not like for like growth comes from 20 hotels that opened last year and around 15 that opened the year before that. And in this last gone by financial year, we have signed 53 new contracts, which means signing a contract a week. And we have guided that we will open a minimum of 2 hotels this year. The guidance is of 25, and our stretched goal is around 30. And all this is on a different kind of a business model, which is capital light. When I say capital light, it means management contracts and operating leases for our Ginger brand. And given that, I think our not like for like growth will help us for any kind of headwinds that might come in one month or the other. But for the next year and the following year, I think at least for 3 years, given the figures that Horwath HTL has given of more than 10% compounded growth in demand, we feel we are very well positioned with the number of locations, with the diversity of our top line, as well as the kind of portfolio we have divided over leisure destinations, business destinations, and more than 50 spiritual destinations. I come to number 3 point, which is very critical, is the infrastructure growth that the government has been driving in the country. So if we get to more than 150 airports, if we get to the new trains, bullet trains, Vande Bharat, etc., what I call the renaissance of the train stations, and if you're getting into another 100,000 kilometers of 4-lane highways, I think that all is going to support this sector for many, many decades to come, and not years to come. And last not least, there is a fundamental shift, be it because of the growth in GDP, be it because of the growth in people earning more than $10,000, currently 60 million, projected to go to 100 million, as well as the additions like Bharat Mandapam in Delhi, or the Yashobhumi in Delhi, or the Geo in Mumbai, or the Kolkata Convention Center. I think there is a structural shift, and we have not even captured 5% of the possible demand that these big centers could bring into the sector going forward.
Mr. Chatwal, you've opened one hotel a week. That makes it 52 hotels for the financial year gone by. Is it possible for us to perhaps understand that how much of the growth is coming from new properties and how much of the growth is coming from your historical properties which are more than 5 years old?
So currently, we have defined and differentiated it into new businesses and our traditional, and we are at almost 14% of our top line is coming through the new businesses, and the projected short term is at 20%. But that is something the management worked upon in the last 5, 6 years, is driving operating leverage in our traditional business, in our iconic assets by, by implementing and executing on effective asset management and driving margin expansion through the capital light business model, which I just spoke about.
While Taj and Indian Hotels is the leader by by any yardstick, but what is the right way of looking at the market share of ihcl, because you represent multiple categories, because that is one matrix markets always look at.
So I think because of what I spoke about, the diversification of top line, there are various ways to look at this. When it comes to palaces, we are absolute leader with the iconic palaces that we have, and we maybe have 80% of the share of the market. If we look at our flight kitchen business in a joint venture with Taj Sands, we have 60% market share, which used to be around 37, 38 in the past. If we look at normal business hotels, whether they are branded as Taj or Vivanta or under our named collection of selections, then it's anywhere between 15 to 20%, because that's a very large chunk of the market. So all in all, I would say if we can maintain more than 15% of the total share of the market, which is in terms of branded supply of rooms, is 180,000 rooms, less than 200,000, then we'll continue to drive growth, drive penetration, drive premium results, especially because coming from the house of Tatas, we also go and build new destinations. It takes time, but we also get the premium when these destinations open and attract a lot of new business. And in the past, like 5 decades, Goa is an example. 4 decades ago, Kerala is an example. Today, Havelock in Andamans is an example. Tomorrow, it will be the Lakshadweep and Ayodhya in India, which will be an example and benchmark for us.
You've incubated a lot of new businesses during COVID, and I must point this out for our viewers that when the hotel industry was on a brink of existential crisis, Indian Hotels and Mr. Chatwal and his team, they decided to expand and experiment with different formats. And that is something which now is clearly beneficial, is visible now if I look at the contribution which is coming from the new businesses. So how are the new businesses doing, and what are you planning to incubate in FY25 and beyond?
Firstly, Nikunj, we have come up now with a new organization, and that's also in the numbers, which is dedicated and focused on new businesses. That means the new businesses which have been reimagined include Ginger, include Ama, include Cumin. In its very first year of this reorganization, actually hardly 6 months ago, we have seen an exponential rise in signing 104 homestays last year. This is besides the 53 hotel contracts that we signed. So our portfolio of Ama has now grown to more than 200, of which more than 100 are operational, and the number of homestays coming into operations will rise exponentially. Number two, we are also very pleased to announce that Cumin, which has been launched during COVID as a home delivery business, has also migrated into home delivery and quick service restaurants. We call it the Cuminization of Ginger. So all Ginger hotels, all day dining will be Cumin. And Cumin has crossed 100 crores in GMV for the first time in the last financial year. Half of it is coming through QSR, half of it is coming through the delivery business. And I think with Ginger, the story really started with the opening of Ginger Mumbai Airport at Santa Cruz. Of course, the name is old, but we reimagined the brand, and now our Lean Lux portfolio is 75% of the total Ginger hotels in operation. And the Lean Lux portfolio is driving more than 50% operating EBITDA margin, which we are very pleased, and there is still room to grow on that front. So all in all, new businesses over the next 3 years should see 30% CAGR, and that is what we have guided yesterday in our press release going forward. And this will be mainly driven through these three brands that I have mentioned. Besides that, in the next 6-8 weeks, we are launching the first two hotels under our reimagined Gateway brand. So we are bringing Gateway back into our portfolio, and we have also given the list of first 15 hotels that will be branded as Gateway and will open as a combination of new construction as well as some of the rebranding over the next 18 months.
I have two follow-up questions. One is short term and the second is long term. I'll start with the short term first. If I really compare FY25 with FY24 with FY25, FY24 there was an advantage of G20. There was World Cup which was at play. Spiritual tourism because of Ayodhya, it really started booming. Those factors may be missing for FY25. So as you talk about FY25 and as you look into your order book right now, what can you share with us?
See, currently, we have, despite all the holidays, in the first 2 weeks of April, we are still trending at a top line which is more than 10% in the total revenue. We don't see a change in this trend because we benefit from the demand-supply imbalance. And as I said already, our not like-for-like growth will continue to assist us in driving performance. But having said that, I think the impact of G20 is not just 1 year. The Bharat Mandapam was built for G20. The Yashobhumi, as I said before, these centers are going to capture large events, even in the short term, totaling 2,000, 3,000 people events, and they need accommodation somewhere. So in the key markets where we have the leadership, like Delhi, like Mumbai, like Bangalore, like Kolkata, I think we are very well positioned to benefit from that uptick. And there will always be something that is not, kind of a constant in the market, but also some things in our portfolio will not be constant. We did not have Taj Mahal Hotel Delhi for full 12 months last year. We did not have Ginger Santa Cruz Airport, which opened only like for 4 months of last financial year. We did not have Taj Usha Kiran Palace in Gwalior. So I think all in all, we are very comfortable in giving the guidance in the short term that what we promise, we deliver. And up till now, whatever we have promised, we have delivered a bit ahead of time.
Votary of that, it's just been such a pleasure tracking the company the last couple of years that it's quite extraordinary. I mean, I always say that this is such a proud moment when you hear that Indian Hotel has become like a case study in Harvard. And I tell my team and we discuss with our friends that it is not the Harvard case study, it is the hard work which has really made all the difference when it comes to Indian hotels. My next question, Mr. Chatwal, is that as you grow, the benefits of operating leverage has kicked in, which is for the benefit of our viewers. PAT has grown at a percentage which is higher than the top line. Can you maintain this kind of an operating leverage advantage? Because 30% margins, which is where you reach now, are hard to stretch beyond a limit.
Actually, I think there is a key learning the management has had and a very important belief. Asset heavy or capital heavy assets are really an opportunity if the renovations that happen there and the usage of space, the return per square feet in these properties is a very big opportunity. So Taj Mahal Hotel Delhi is a very good example where the license fees went up by more than 80%. We invested 250 crores to renovate and reposition the hotel. It still ended up in 10.5 months post renovation in a high PBT positive number close to the contract we had earlier. So I think the iconic assets in very, very important locations present a very big opportunity because there is lots of space. If you had to acquire that space today, it would cost a fortune. So I think there is still a way to go with our assets like Taj Lands End, Taj Mahal Palace in Colaba. There is a lot of opportunity in Taj Palace in Delhi, St. James Court in London. So we have a good, set of assets. And if we keep investing intelligently based on both satisfying the customer needs and wants, at the same time not forgetting the return on capital employed, I think we will be in a very good space. And our combination of capital heavy and capital light, which is today at 40-60, and could grow to 30-70, 70 in favor of capital light, will drive both operating leverage as well as margin expansion.
So I'm assuming there is scope for expansion, at least at the operating leverage front, which will automatically lead to a bottom line boost. My final question, sir, is last 3 years versus next 3 years. Last 3 years, you've created new businesses. You've made the balance sheet healthy. The company has made a comeback. Profits now have crossed more than 1,000, then 4-digit now. That's the summary of last 3 years. Expansion, growth, and real comeback for the hospitality industry. But my question is, how do you see the next 3 years moving? Because now if I say hospitality sector is in a boom, ये घर घर की कहानी है.
घर घर की कहानी तो है, लेकिन हम कहते हैं अभी पिक्चर शुरू हुई है because we have more than 90 hotels in pipeline, of which only 25 to 30 will open this year, and we have not stopped signing new contracts. So no matter what we do, if we end up opening 100 more hotels in the next 3 to 4 years, of which let's say it's 10 to 15% capital heavy and the rest is capital light, I do believe that the growth journey and the growth story will continue despite any headwinds, and some will definitely come. So despite any headwinds that might come our way, the important fact is that Indian Hotels is not just anymore an iconic hotel company, most profitable hotel company, but the highest growth company in the sector in all segments. We are going to spend, as we have guided, a huge amount on digital to improve our competitive advantage in data lake, in our ERPs, and we'll continue to invest in the communities that we work in. And I feel that our customers will continue to reward us and use our brands as a preference and choice going forward.
Well, I must share with our viewers that Indian Hotel now is commanding P multiples which are almost equivalent to what consumer companies are commanding, P multiples of 50 1 year forward. And that's largely because markets are now convinced that, look, the hotel industry, yes, it has a cyclicality element into it, but when the industry is going through such a boom time, and when brands are getting created, and when asset allocation and return on equity is moving the way it is, then it really deserves a better premium positioning. So Mr. Chatwal, always a pleasure to talk to you, and it's been such a pleasure for me personally tracking the journey of Indian Hotel and kind of good work you and your team have done. It was like, it looked impossible 5 years ago or 3 years ago when we thought that Indian Hotels would ever be close to 600 rupees and will have a commanding market cap which could be nearing 1 lakh crore. So thank you very much and congratulations in what looked difficult, but you made it look easy.
Thank you. Always a pleasure to speak to you, and thank you for tracking us so diligently.
If you like this video, then like, share and subscribe to ET Now.